Hello and welcome back to kind of the second lecture you will see from me. And this time I will talk about the resilience and vulnerabilities of money market funds. And I will take you through this lecture like in 5 steps. First, I will give you a brief overview of the MF reforms after the Great Financial Crisis. Especially like looking at measures which have to be taken to improve the resilience of money market funds, then go into more detail on the stress testing guidelines for EU money market funds, and look at basically like a real-time market stress we have seen in 2020, and so which type of impact the COVID-19 related market stress had on money market funds. And then give you kind of a brief outlook on also the lessons learned from those 2020 events, which kind of feed into the review of the money market fund regulation. So on the reforms after the Great Financial Crisis. So it has become very clear that money market funds were kind of a bit of an issue from a financial stability perspective during the Great Financial Crisis. So and overall, like after 2008, financial stability has become a dominant idea of financial market reforms, regulatory reforms across the world. And the European Commission developed then the money market fund regulation to support financial stability, but also investor protection. And especially the focus was on help to deal with large redemptions during times of market stress. The money market fund regulation was basically started out in September 2013, like the first proposal was out there, and then you see in the timeline here the entire legislative process, like the vote by the European Parliament and the adoption by the European Parliament of the and the European Commission of MFR, like in June 2017. So MFR then came into force in July 2017 and was implemented at the beginning of 2019. And this has been kind of accompanied by issuance of technical standards by the European Commission and also by ESMA guideline on reporting to NCAs. And the first reporting of money market fund data, and the content of this we have talked about in the previous lesson, was basically in September 2020, and this is covered so we have data from the beginning of 2020, and the first reporting of that was in September 2020. Now, overall, kind of what was the goal of that? It's kind of the harmonization to increase resilience, the harmonization of potential requirements. So it's really the introduction of uniform rules across the EU for all EU money market funds on the composition of the portfolio of MFs. The details we have discussed also in the previous lecture, but the main goals are really, here's about the goals, and the goals are fourfold. It's to improve the resilience of MFs and ensure the ability that they can meet redemption requests, especially in times of market stress, and also contribute to kind of the smooth operation of the short-term funding markets. And there's also the overarching goal that there's kind of MFs can be a reliable tool for cash management needs of the industry in the European Union, because this is one of the main purposes, apart from investment purposes, for retail investors and also institutional investors from many parts of the industry, whether in the financial industry or also for corporates. MFs are important cash management tool. Now, what are the measures to improve resilience? It's kind of threefold. And basically, it's about addressing the problem that funds can meet redemption requests during times of market stress, and investors get not worried about not being able to get out of the fund. So basically reduce vulnerability of money market funds to kind of fund runs. So 3 types of measures there. First one are liquidity fees and redemption gates. The second one is transparency to investors and regulators. And the third one is stress testing. And I'm going to talk you through that now. In terms of liquidity fees and gates, first, basically, like in terms of liquidity fees, what does it mean? It's about basically passing on the cost of basically selling assets into a stressed market to the investors. And gates means basically to restrict the ability of investors to redeem their fund shares, to get out of the fund either partially or completely by suspending the fund shares. And there are very precise rules on basically how to deal with that. So this is about basically the defining criteria here is weekly liquid assets. So we talked about that in the previous lecture as well. So it's basically like how many of your assets, what percentage of your assets can you basically liquidate as a fund within a week? If that falls below 30% of your total assets and you have daily redemptions above 10% in a single day, which is pretty huge, really, then the board of the fund has the discretion to take no action or to implement liquidity fees and or gates. If the weekly liquid assets fall below 10% of total assets, then the board is obliged to implement fees and or gates. And we will come to that in a minute when we look at the 2020 market situation, like where we were like on this front. In terms of transparency, and here we're talking about transparency to investors. Investors should be informed at least on a weekly basis about the maturity breakdown of the portfolio of the money market fund, about the credit profile of the fund, about the weekly basically weighted average maturity and weighted average life of the MMF, the 10 largest exposures, the net asset value, and the net yield of the fund. Now, more specifically on stress test. So first of all, like why are stress tests necessary for money market funds? Stress for money market fund can basically like realize through if two things come together. First of all, you have a stress in the market, which means like prices are volatile, they are going down for the instruments the fund is investing in, and also the liquidity dries up. And during times of market stress, liquidity money market fund is a big issue. Then the second point is you might face during this time of market stress large redemption requests by clients. So what you need to do as a MF under the MF money market fund regulation is you need to carry out stress test scenarios and explain that in a bit more detail in a second. And you have to set up tools to know your customer. So looking at knowing about the likely redemption requirements. And this may, to a certain extent, can be planned to a certain extent if basically there are regular cash management needs by your clients. But also you can look at basically like historic behavior of your clients and also similar type of clients, how they have behaved in the past in terms of redemptions. Now, more detail on the stress testing guidelines. So the requirement is that you have to, as a fund, you have to conduct stress tests based on objective criteria and consider the effect of severe and plausible scenarios. So really like we had really significant market stress. And ESMA has published like 4 years ago guidelines for the framework of a stress testing scenario framework for money market funds. And these stress test scenarios are updated on an annual basis. So what does this basically like these scenarios include? And they then have to be implemented and funds have to run their calculations based on these factors. So first, like we're talking about a macroeconomic shock. We're talking about liquidity levels in the asset markets of the assets MFs are investing in. We're talking about assumptions about credit risk, about interest rate risk, kind of how do interest rates move, how do foreign exchange rates move, what are kind of really strong and very high redemption, what are the levels for that, and also kind of what are kind of different spreads among indexes which are relevant for MF investments. Now, there's also importantly for stress tests, there's a narrative behind it, and let's go a bit through the narrative of the 2021 stress testing guidelines, which are very much basically like influenced by also the situation we have seen under the COVID-19 related market stress in 2020. And the scenario is based on the assumptions by the European Systemic Risk Board of their assessment. What are the prevailing sources of systemic risk? And in general, it assumes an upward trend of risk-free rates on account of a rise in inflation rates, which is in fact what we are seeing at the moment. And this looks like at three elements then: at the impact on the corporate sector, on the impact on the sovereign sector, and on the impact on markets. On the corporate sector, at the top, it's about increased credit risk, and also an increased number of insolvencies due to slower growth in the economy. On the corporate, on the sovereign side, the stress test scenario looks at the reemergence of sovereign debt financing risk and also debt sustainability concerns. And on the market side, basically, like, the scenarios are looking at kind of how whether we could have kind of disorderly asset price adjustments, like kind of large price falls, high volatility, lack of liquidity, with basically like which could then lead to episodes of market disruptions and money market funds not being able to sell their assets if they would need to, or only at discounts. Now, looking at the impact of the COVID-19 related market stress in 2020 on money market funds, I will talk you through three aspects of that. First, like the redemptions kind of MFs faced, then what happened on the asset side, and then also what happened like with the issues around the regulatory requirements on liquid assets. Now, on the redemption side, so what you see here is that we saw very large outflows for certain types of money market funds, but not for others. So the highest outflows were for low volatility NAV funds, and they lost around like 20% of their assets within 2 weeks, or more than 20% of their assets. And we also saw pretty large outflows from VNAV funds, but to a lesser extent, around 6% of their assets in the 2 weeks between the 11th and 25th March. But you saw massive inflows, in fact, like basically like into constant net asset value funds. What were the drivers of that? First, it was really the liquidity needs of investors. They also ran into trouble, and for USD LVNAV funds, you have a lot of basically like kind of institutional investors, but also there was also issues on the asset market side, like the inability of corporates to issue commercial papers. There were margin calls, and basically like there was a switch also like by investors from USD LVNAVs to USD CNAVs. And this was kind of a European side. In the US, like similar observations, large outflows from prime money market funds and inflows into government money market funds. And when you look at VNAVs, especially like the green line, there has been quite a bit of heterogeneity between fund domiciles. So VNAV, very large market in France, and here you saw significant outflows. It was like around 16% of French outflows of French VNAVs, whereas for non-French VNAVs, there were significant inflows. So it's really also potentially about the type of investors, why you invest in money market funds, and which has a significant impact on the way you behave like as an investor during the times of market stress. On the asset side, first on the left-hand side, looking at the US. So basically like US dollar commercial markets froze in March. So there was a spike in yields on commercial paper, and basically no liquidity of all. There's a lack of trades. The US Federal Reserve was even unable to publish data on basically like kind of on US commercial papers for a couple of weeks. And for issuance, basically like also like because you have kind of short-term papers, you need to have constant issuance. Basically like both for CP and CD markets, there was a shutdown, very low issuance, and only at very short-term maturities. Euro commercial paper markets did shut down as well. And you saw an increase in yields, basically like no issuance at all, or very low issuance, and only at short-term maturities. But you basically had the European Central Bank kind of stepping in and helping, and that really helped to stabilize the markets. But there had to be kind of there was really significant central bank involvement to stabilize the kind of the money markets. Now, what did that mean in terms of for kind of low volatility NAV funds, which had kind of the largest outflows, and also in terms of requirements for the weekly liquid assets, whether they had to introduce kind of liquidity management tools. So what you see is that basically, like, you saw kind of a significant decline in basically like weekly liquid asset for US dollar denominated LVNFs. And this happened from January to March. It already started a bit before COVID, but then was accentuated. And we had a strong decline in average weekly liquid assets, and we had rising breaches of kind of 30% limit. So basically, money market funds then had to consider redemption fees and gates, and some of them have implemented them. And then from the end of March, basically like markets recovered pretty quickly due to kind of also large kind of central bank and fiscal support, and market conditions relaxed, and also redemption conditions relaxed as effect from that, and also then the ratios of weekly liquid assets pretty much recovered to levels higher than before the stressed market conditions. Now, what does a LVNF do in such a situation? So the LVNF has to meet two requirements. It's the weekly liquid assets, but also then its asset value cannot deviate by more than 20 basis points from kind of the nominal value from 1. And now basically like the fund faces large redemptions. Yes, fund has two options. One, it can sell kind of liquid assets out of that pool of weekly liquid assets, and then faces the risk of a regulatory breach if the weekly liquid asset ratio falls below 30%. The second option is basically like to avoid that breach of regulatory thresholds on the weekly liquid assets is to sell other assets, which are less liquid, and then lead to losses when you're selling those into the market, which then leads to a deviation of the net asset value of the fund, which might be above that threshold of 20 basis points, which would force the conversion of that LVNF fund into a variable NAV fund. And that is something like fund managers then have to deal with in that situation. It's also something which then kind of these lessons from the COVID-19 market stress, like what happened like with redemptions, what happened on the asset side, what are potential conflicts between different types of regulatory rules, led also into kind of the review of the money market fund regulation by the European Commission, and also into kind of looking at money market fund rules across the world in the international regulatory community. Now, the European Commission is preparing its review of the money market fund regulation in 2022, basically now. And this basically like was already like enshrined into the money market fund regulation into Article 46, but it also obviously has become much more important, like to look at the lessons learned from the COVID-19 market stress. And it also takes into account regulatory developments in the international space. And the Financial Stability Board like is also working very closely on that topic, and it has highlighted two main vulnerabilities of money market funds. First, it's the risk of sudden and disruptive redemptions. And how does this come about? It's basically the liquidity transformation performed by money market funds. So slightly short-term assets, but still slightly longer-term assets than kind of the redemption period funds give to their investors. And Also, the use of money market funds as cash management vehicles, they make them prone to large outflows when markets are stressed. And that's what we have seen in the great financial crisis. That's what we have seen for certain type of money market funds during the COVID-19 market stress. And then the funds face challenges in selling assets to meet the redemptions. So especially in terms of market stress, limited liquidity of their assets, and also a high overlap of the portfolio of money market funds. So money market funds tend to hold similar instruments from similar issuers. So it means that different money market funds might want to do the same thing and sell similar assets into a market, and which makes it difficult from a liquidity and pricing perspective. Now, what are the proposals to further enhance money market funds resilience? Out of the FSB, kind of there are three areas. It's reducing threshold effects, things like kind of you have certain kind of thresholds where a fund needs to do something, for example, like weekly liquid assets of 30%, then you take action. And second point is impose on redeeming investors, especially in terms of market stress, the cost of the redemptions. And the third element is reduce liquidity transformation. Now, on the European side, we have the ECB on this and also ESMA. And the ECB issued in January of this year, like a recommendation on the reform of money market funds. First part is, relevant part is decoupling kind of liquidity fees and gates from the weekly liquid assets. And this is kind of to avoid basically also like the things we have seen in slide 18 on how can funds deal with kind of conflicting regulatory requirements when they need to sell assets. Its second point is increase the liquidity requirements. Third point is imposing the cost of redemptions on redeeming investors. And the fourth point is enhance the monitoring of MFs and stress testing of MFs. ESMA has published in February of this year a report on the review of the money market fund regulation and the views of ESMA on this. Here, kind of four main points to mention is to reduce the first mover advantages of low volatility NAVs, because like if funds have a risk that they need to convert kind of their statute, you might want to get out first. And this can then in fact like trigger the entire process. Second point is decoupling the regulatory thresholds from fees and gates. Third point is increase of daily, basically like of the requirements for daily liquid assets, weekly liquid assets for VNAVs and LVNAVs. And the fourth point is also include public debt assets in liquidity ratios. Now, if you want to dig deeper into this topic, here's basically a list of further readings. And with that, thank you very much for your attention and have a good rest of the course.